Welcome to Java. Thank you kindly for joining me. It's December 27th, 2024, and it is Friday on a holiday shortened week. And I hope that everyone has had the opportunity to spend time with family, loved ones, friends, because to me, that is one of the most important things and why we do a lot of what we do. So, with this, I just wanted to say that this will be a short episode just to go over what is going on in the market today, because I'm working on a few other deeper things and a larger project that I hope to come out with. I will also be going over what I see coming forward for 2025, along with a lot of other people coming out with their predictions. I'm coming out with some probabilities and advancements that I see as affecting our lives coming forward this year. And there's some truly incredible things. But with this, I would also like to mention that next week is again holiday shortened week as New York celebrates the new year. On Wednesday, markets will be closed. So with this, we've got a few other things we've got to look forward to in this market. So let's go ahead and get started with this. And I will be in on Sunday for just the week ahead as well as that going forward. So this morning, we've got the MMRI, our favorite risk indicator, 309.3. It hit over 310, spiked to 313 briefly. So a lot of this is the imbalances that are happening in the debt market as well as relative strength of the dollar. These are the two major elements with this. Now we've got the Dixie dropped back below 108. Now this is relative strength to other currencies, and we've got some serious currency wars going on as well as trade. With this, we also watched in the debt market, the 10-year yield 4.611. Now this is elevated, and it looks like it could go a bit higher. It is, however, on the charts in a technical going into a resistance level. So hopefully recover from here. That means that someone would have to be buying the debt. So in my opinion, this is what to keep an eye on this morning. Now we've got the fear greed meter is up a little bit. More retailers coming back in. It's up from 31 as it was the other day. Now, the sentiment now is a bit distorted. We've got low volume of traders. That is causing high volatility. So that is the low vol, high vol that is in the title, because the low volume means severe moves in markets, not just stocks, but other markets as well. And this is because institutions are not trading full volume until January 6th. Now, they've still got their trading desks open. However, institutions are only doing mostly algorithmic buying and selling. They've got preset levels and not doing a lot more other than that. So that is what is driving a lot of this. Now, we've had markets relatively flat, which is a little bit surprising because normally the retailers have been pushing the markets up, and we've got the futures looking like they might have a little bit of a drawback later today. Volatility spiking, that is to be expected in this environment, and oil is slightly up. This is really on a couple of other events that have happened in the Middle East, more bombing and such going on. Now with this, we've got the calendar, advanced trade balance. Really not a lot going on. I don't think any of this will be major movers. The trade balance is another factor that we watch because this is the flip side of the currency wars. Now with this, we've got BRICS economies to surpass half of the global GDP in a challenge to Western dominance. Now, if they are the major manufacturers and creators, of course, they are going to get more dominance because currency is only the earmarker for how this trade is setting as far as the balance sheets. So if they're actually producing, this is a factor. With this, we had, speaking of, the IMF came out with a dollar dominance warning, saying more countries are stepping up efforts to move away from the dollar. So US dollar greenback is a nickname in case you don't know about this. They are trading either in local currencies, since the petrodollar has been annihilated. So this has broken the tie that everyone must purchase their oil and energy in the US dollar. Now, since they can trade in their native currencies, it is creating weakness here. However, as we just saw, the US dollar, with the faith in the new administration coming in with the policies, all of the tariffs, it is pushing the relative strength of the dollar higher. That sounds odd, but uh, there's more faith going into the trade and what is going to be happening with the policies and the actual GDP and trade in the background, pushing that dollar value up. Now, with this, the dollar going up is causing the debt in Europe to fall. Thin volumes compounding the moves and extending a rapid sell off this month. Now, these are all interrelated. And what is happening here is we're watching these currency wars kind of play out in real time. The yen carry trade is the first example of this, and I believe there's more to come, but I'll get into that when I go over the looking forward to 2025. So with this, the economy, we've got mainstream, as I always say, versus the real economy and what is going on. Now, we've got in the news saying holiday shopping surging, flexing the strength of the US economy. Now, United States consumers are the largest in the world and driving the economies of many other nations. Now, as I was saying, Goldman Sachs coming forward with their 2025 artificial intelligence predictions. And here's what to expect also moving forward. I'm going to be touching on this because this is part of what I've been diving into, and it's nothing short of incredible, but I'll speak about this more in that. So, with this, they're saying our economy is surging, yet we've got multiple stories about restaurants and retail shuttering. We've got America's largest barbecue chain, a restaurant, it's Dickies, shutting 30 locations amid declining sales and franchise issues now. They are nationwide, but they're largely in Texas. And they're having a lot of these issues, not just with the product that they're selling, demand dropping, also labor costs. So all of these tie in. Now, I'd like to touch on housing just a bit. And this is because we've got conflicting stories here, and you're going to see more. We've got Miami leading as home prices fall in major United States cities. These cities include Austin, Texas. They include Denver, Colorado, few other cities in Florida, as well as California. Now, along with this, we've got mortgage rates jump, finishing the year at a 5-month high. Now, if you look at the home sales, they're trying to say that home sales are improving and that this is going to jump the wealth effect, when in fact it is not. And while they're talking about prices falling, the price to consumers will not be cheaper because they've got mortgage rates increasing as well as insurance and homeowner associations. So the overall cost of housing is still increasing. We've still got inflation here that is causing issues in the ripple out effect. I will also be speaking about housing going forward. We've also got a major story that hasn't been in the news as much, in my opinion, as it should be, and this is the Panama Canal. Now, the incoming administration is having a bit of an altercation looking at taking over the Panama Canal, because this would obviously give back to the trade wars, would give a serious leg up if they control the main shipping route in the Western world between North and South America. So with all of this, it's just a bit of what is going to play forward into what we're seeing this coming year. So looking forward to that. It's still got quite a bit of work to do on it. I'm hoping to have it out by Sunday, but I will see you Sunday one way or another. And missed you all. Hope you've had a wonderful holiday. And until I see you again, good luck today in your trades if you're trading. If not, then I'll go in depth in some of these, and I'll see you all soon.